The objectives for this lecture is to discuss the fundamental importance of chart pattern recognition, reviewing methods for identifying support and resistance, along with trend lines, reviewing the methods for identifying those chart patterns for the most common bullish setups, and discussing the tactics and insights related to those patterns. So, what is it about chart patterns? For one, they apply to all trading vehicles, futures, options, equities, given that it's a graphical representation of price movement. It empowers you to see the big picture such that you get a global sense of what's going on, or what's going on with the story of the price. Another major key point is that chart patterns do not lie. They have an accuracy rate of around 70-75%, but then again, nothing in life is guaranteed. That's why you'll see these little fine prints right here. It may also be a common weakness in automated or algorithmic trading systems. However, don't take it literally, as there's not enough substantial evidence to back up this claim. But it's just that upon reading several journal articles and white paper studies, a lot of the researchers point out that a common weakness in their trading system is that it's not able to detect the chart pattern as accurately as it can, especially with like the erratically shaped ones. And a huge disadvantage for chart patterns is that they are very subjective, and it's common to misinterpretation. Next up is trend lines and support and resistance, otherwise known as SAR. So there are multiple ways to determine SARs, such as moving averages, cloud, Fibonacci, but the most easiest way for me, at least, is looking at the historical price action. So in order to determine where the SAR is, you're really looking for where the price action hits the most. So right here we got a base. Around here is another one, since it hits the top of the wick. Here the price action seems to hit, most commonly hit here, and so forth and so forth. Now on to trend lines. Drawing the trend line on the body of the candlestick itself gives you the idea of where the main trend is, and drawing them on the wicks gives you the idea of SARs. Let's say there's too many crazy wicks. What I'll do is I'll take the median, and that right here will be my SAR. Let's say if you get like one crazy long wick, that's usually due to these automated trading systems like going haywire, or there's like a major event that just went on. I'll ignore that wick right there, that really long wick, because it's usually just noise. Some key concepts to remember about trend lines: the more times the price touches the trend line itself, the more reliable the price action is, and also the trend line angle. The sharper the angle, the more violent the price movement will be. So let's take a 90-degree angle, cut it in half, you get 45 degrees. Or anything over 4 to 5 degrees, the more violent the price action will be, and anything less than that, it's gonna be the opposite. That's why in these low float momentum stocks, they'll go parabolic, then take a dive shortly after. On to pattern recognition basics. SARs and trend lines, these act as the skeleton for the pattern itself. Turning on the logarithmic scale in your charting platform allows you to see the patterns much easier. And definitely the screen time and experience is the most important one. Remember that chart patterns are very subjective, and it really does take some time and practice to recognize them. And also, to make things confusing, there can be a pattern within a pattern. Here are the average time frames for patterns to complete their formation, and the values are based on the daily chart. As you can see here, they're generally around like a few weeks. Situational awareness is important as patterns can break up or break down prematurely. Let's say if there's news that came out. Chart patterns also work for all time frames, and it's not necessarily limited to the daily charts. It even includes pre-market and after hours, given that there's enough volume to form a candlestick. General key concepts: you get the most price action with patterns that are tall and narrow. Narrow because the less space there is in between the candlesticks, or the more tight it is. Think of it as energy that's being compressed, then eventually being released. This right here. So when a pattern is confirmed, the price breaks above the SAR. Typically, for patterns, you want to see the price action break more than 10%. Anything less than that, it'll increase the risk for the pattern to fail. Don't disregard any pattern due to lack of volume. Generally, the U-shaped volume histogram on a pattern performs the best. When you see volume tapering off, it's really more of an indication or clue that there's going to be a shift in trend or momentum that's going to happen soon. However, it does not tell you where the direction will be. So be cognizant when the volume tapers off, as it can either be a reversal or a continuation. Don't trade against a trend, you'll just lose money. Ideal entry stop losses are usually less than 5%. And remember to trade defensively, as you cannot predict the future. Now on to discussing the most common bullish setups. The first one up is the ascending triangle. What you want to look for is a horizontal resistance line with an upward slope. And then another characteristic of this pattern is that in order for it to be considered an ascending triangle, there has to be minimal space in between, such that it fills a triangle. If there's too much space, it invalidates the pattern itself. So in this example, there is the horizontal resistance line with the upward slope. Notice that the price action of these candlesticks, you want to select the ones with the least amount of empty space in between. Here at the apex, that's considered the crucial turning point of the triangle itself. A break above it will confirm the pattern. If you could also take a position here at the apex itself, however it does carry a higher risk. It's ideal to take a position a little bit above the break right here. This one is not an ascending triangle. As you can see, there's too much space in between here. Here's the summary slide for the ascending triangle, and remember that the apex is the crucial turning point for the price action. Now these are usually continuation patterns, so in order for it to be considered as a flag or a pennant, they must have a pole, meaning that the straight line price action run is usually in like a linear type of manner, and it doesn't necessarily have to be vertical. It could trend upwards or trend downwards. So, and they also must be shorter than 3 weeks. If not, if they're longer than that, that invalidates the pattern. As you can see here in this example, here's the straight line run, and for the pennant, the trend lines are converging. So, and then if you look at it at a further type of view, here's the straight line run again, and here's the flag. And then pennants of flags, they almost always have a pullback. So this one is not a pennant, as the timeline of this chart is from January till February, so that's greater than 3 weeks. It's really more of a parallel channel down. So here's a bull flag, same concept as a pennant, except that the trendline SARs are in a parallel manner. So here's one with the price action pointing upwards. As I mentioned earlier, pennants and bull flags almost always experience a pullback from the predominant price trend. So now when you're selecting these, you want to get the ones that do have that pullback. Otherwise, the flags and pennants that trade along with the predominant price trend, there's a tendency to experience like price action exhaustion that way. So you can see here with the flag pointing up, it didn't really rise as much. So here are the summary tactics. They almost always have a pullback, so expect one. And then you want to select the flags and pennants that do have that pullback. Otherwise, if they trade along with the price trend, it tends to experience exhaustion that way. And the tighter the better. The reason being is that think of it as energy being compressed, so you get more explosive at price action. And then also always identify the predominant price trend. Falling wedges, these are often sharp bullish reversals. They also go by the names of bearish wedges or wedge down or falling wedge. They generally follow the same concepts as triangles and pennants, except they point downwards and there's no flag pull. So in this example, the predominant price trend is identified, and here are the falling wedges. And as you can see here, the apex is the crucial turning point for the direction of the price. So you're going to want to look for a break above or a break below. And keep in mind about the angle as well, because the sharper the angle, the sharper the moves. Some key points to remember: the angle of the price trend and the apex. You also want to trade with the trend, because usually these move like pretty quick, and you definitely don't want to be caught on the wrong side. Double bottoms, two values near the same price, and as a rule of thumb, for it to be considered as a double bottom, the price of those valleys have to be within 5%, and there can be some exceptions. And for it to confirm as a double bottom, it has to break above the highest peak. So here you'll see the two valleys and the break of the highest peak. So around here or here would be the ideal entry. This one isn't really much of a double bottom, although you do see two valleys. However, the height of the pattern from valley to peak is less than 5%. So these ones, I would consider it more of a rounding bottom. This one's rather subjective. So if you include this wick and as the valley itself along with this one, that would not be a double bottom because the price difference is way too high. But if you ignore it, then yes, you can consider it as a double bottom. So here are some variations. Atoms are the tighter valleys, or the much more narrow ones, and the eaves are the wider ones. So some insights: taller ones generally have the best price action, and also the angle of the valleys themselves. The best ones are with the double bottoms that have nearly at the same angle, or the ones with a downward angle. The ones with the upward angle, you do have to be careful of these. These tend to revert quicker. Triple bottoms, identification is the same as the double bottom, except that there's a third valley. If there's more than 3 valleys, then it's considered as a multiple bottom. So here's an example of a triple bottom with the 3 valleys, and the 3 valleys are within 5%, and a break of the highest peak is a confirmation of a buy signal. Now if you look at it in terms of an aggregate level, you can consider this whole pattern as a cup. This one isn't a triple bottom, it's really more of an descending scallop. This one may be subjective. There is 3 valleys, however when you look at the big picture, it's really more of the handle of this cup and handle pattern. So some tactics: a break above the highest peak will confirm the pattern, and the best ones to trade are the short and narrow ones. Inverse head and shoulders, 3 valleys with the middle valley being the lowest. pattern is generally symmetrical, and the neckline, how you find them is by drawing the trendline SAR of the peaks. And if you cluster these values together, it can form as a complex inverse head and shoulders. In this example, you'll see that the neckline slope is right here, and a break above that confirms as a buy signal. Here is another example. One thing to keep in mind is the angle of the neckline. Generally, the ones with the downward slope or the horizontal slope has the best performance. Also, if you zoom out to see the bigger picture of this pattern, you could also consider it as a cup and handle. Here are some key points. Keep in mind about the slope of the neckline, and a break above that confirms the pattern itself. And then what's also interesting is that this type of pattern has the lowest failure rate in a bull market. Cup and handle. So 3 attributes. It's U-shaped, and the depth from rim to cup is at least 10%. Anything lower than that is considered a rounding bottom. And the handle usually resembles as a flag or a pennant, if not a short pullback. So here is a classic textbook example of the cup and handle. From rim to base is greater than 15%, and the buy signal is generated when the price breaks above the rim. One thing to keep in mind is the handle itself. If the handle retraces anywhere near halfway to the cup, that actually increases the risk of the pattern failing itself. As a rule of thumb, you want to keep the retracement of the handle less than 1/3. The lesser the retracement, the higher the price action. So here is a complex cup and handle. As you can see here, here's the triple bottom, the cup itself, and the rims. Now, if you discovered a cup that's forming within a cup, you generally buy in the inner cup itself. Now, something about the rims is that if they downslope or if they have a horizontal angle, those generally have the best performance. This right here is not a cup and handle. As you can see here, the cup's depth is less than 10%. Overall, this pattern is really more of an ascending scallop. This one is rather subjective. Let's say you consider this area right here. That would not be considered as a cup because it's too sharp. That's really more of a V shape rather than a U shape. But if you consider these ones over here, you do get like a very sharp cup itself. Some key points to remember: tall cups with short handles have the best performance. Also, in regards to the handle, you want to keep the retracement as minimal as possible. If it retraces anywhere near halfway to the cup, the risk of failure is even higher. So you'll see these patterns in practice, but they're not really too popular. Ascending descending scallops, it's just a J or hook pattern. 3 rising valleys. The formations will vary, but keep in mind it's just higher highs and higher lows. The easiest one to spot for this type of pattern is the stair step pattern. I usually get in by the 3rd or the 2nd stair step. Anything more than that, I'll stay on the sidelines to see if there's continuation or if there's going to be like an imminent pullback. Rounding bottoms, they look like cups, but the price depth is less than 10%, and they are usually very wide, and think of it as a saucer or plate shape. And this concludes for the first part of the lecture series.